Well, thank you very much for our new podcast today. This is Guillaume Rouchabert from Interactive Brokers Singapore. So today we have a very interesting podcast about like the market investment risk insights on global equities. Indeed, like 2025 was arguably the most geopolitically consequential year since the fall of Berlin Wall in 1989, and 2026 seems to be also have a great deal of history in the making. So the US was mainly focused on the AI trade and potential rate cuts, with the exception of the period surrounding the Liberation Day. And non-US markets were driven by more favorable interest rates environment, trade wars and a weaker dollar, and a renewed focus on defense. But of course, we have like a very recent event that are shaking a bit all this narrative. That's why I invited two of very special guests today. So we have Chris Hopkins from the UREX, and we have Olivier Dacier, the Senior Director of SimCorp, who is part of the investment decision research team on macro and geopolitical thematics. And so I'd like to have his insights and his point of view about the implications for portfolio and prices. We're starting with one first question regarding the events that happened in the last few days. So, Olivier, what are the market pricing in terms of how it works and how will it end, according to you?
So this is quite interesting because we've seen a muted reaction first in the US on Monday and with major markets simply because they thought, okay, this was going to be another one of those, bomb from the air for a few days and get out, something similar to what we saw in Venezuela or the 12-day war with Iran last year in June. But by Tuesday, it became clear, and in fact, that Donald Trump himself has said he's planning to be there for 4 or 5 weeks. He's brought up the fact that more U.S. servicemen may die in this conflict, that it may last longer than they thought. There's a little bit of confusion as what the goal is, whether it is simply security concerns, so destroying the rest of the nuclear apparatus in Iran or ballistic missiles capabilities and so on, or regime change, because regime change will take longer. Regime change will have to see boots on the ground type of thing. So I think by Tuesday, markets were already a lot more nervous. So they were pricing in a limited military escalation on Monday. They're pricing a moderate one today. The key factor that pushed them over the cliff, so to speak, is the Strait of Hormuz and what's happening there, right? So 20% of the global oil shipment goes through there, but for APAC, it's 85% of their oil imports that comes through there. So it's really important. So we saw today in APAC, for example, a difference between the markets that have oil, like Malaysia and Indonesia, and the ones who don't and are reliant on this route, like Japan, South Korea, Taiwan, Thailand, which all fell, several percentage points. I think South Korea fell 7% today. So there was a clear play on Tuesday about the oil shock that this could be, or at least if it's a prolonged supply shock to the oil, to the region, that really bothered people. We're seeing some of that play in Europe as well today, right? Again, Europe is an importer of oil and natural gas, and the Strait of Hormuz is a big supply chain for them. So that's really the big question now. How much disruption? We haven't seen, like we saw in the first Gulf War, oil infrastructure up in flames on CNN or anything like that. So that hasn't happened yet. So the Strait of Hormuz being closed can be reopened relatively quickly. So it would be a small blip, but we don't know yet, right? It's really play by play.
Understood. And I'd like to rebound on what you just mentioned. Is it really only like an oil game? Is there any difference between this war that we see now and the past conflicts, like the 2 Gulf Wars in the last year's 12 days war, or the Arab Spring, to that matter?
Right. So let's start with the first 2 Gulf Wars. I mean, they were wars that were fought by the coalition of the willing. There was international agreement that this had to be done. This is unilateral. This is the U.S. and Israel, mostly Netanyahu's war, and he's convinced Trump to join him in it. There was no coalition there. So that's one difference. The Arab Spring did bring about quite a big shock today to the oil supply chain, as well as some supply shock in terms of the infrastructure. So there was a bigger move there. So when we're doing stress testing for a worsening or a regionalization of the conflict, we're using the calibration period as the Arab Spring for the correlations. If we're using limited bombing, then we will use 12-day war from last year as a correlation calibration period. But if we're using, the first Gulf War, there was an oil shock, but there was a correlation there. And it's really not, I think, appropriate to use that historical scenario for this case because of that difference.
Understood. Thanks, Olivier. We had to comment on this, on the recent events. That's why. But now maybe I have a question to Chris to put things a bit more in perspective. So if we come back like in 2025, which is not that far actually, the European markets completely outperformed the US market. Yet we did not hear much about this relative success on the US. So, Chris, you work for Eurex. So, why is that? What kind of trend do you see consolidating or strengthening in 2026 that was embedded in 2025?
Well, I think one of the major problems with the lack of attention on the moves in Europe was that the world's attention outside of Europe itself, like in Asia or the US, was firmly focused on the US. I mean, the US media have been very heavily focused on AI and the tech segment. The Mag 7 was getting a massive amount of attention. And then out here in Asia itself, you had very strong performing markets. You had India doing very well. And then into 2025, you had Japan, very strong performance out of Japan. Taiwan and China were getting a lot of attention. And then in the second half of the year, you had the start of that massive rally in Korea. So Europe has been a big disappointment for people outside of Europe for years, and it's just missed the attention of the last 2 to 3 years, where for me, I mean, I've been in Asia almost 25 years now. You can count on one hand and still have fingers left over the amount of times I've been absolutely positive and bullish on Europe. And it's been within the last 2 to 3 years. And that's what a lot of the market missed. And even in terms of flows, we didn't really see the big investment banks and the big asset manager houses start to really talk and push Europe until into end of Q1, beginning of Q2 and onwards. And that's really where we started to see the flows starting to migrate. But I think, and Olivier, you can probably argue this as well, there's still a massive amount of US and Asia money that are still very underwhelmingly invested into Europe. So the upside there is significant. 2025 is a great year for bank stocks in particular. So banks, telcos, utilities, oil and gas, basic resources, goods and services, and of course the defense index were clear winners last year, and they will be some of the trends that continue into 2026 as well. It will be almost a repeat of what we saw across 2025 and then some as we move into the middle part of this year. And I think the key driver is going to be a continuation of that great relocation out of US into Europe, and then Asia will start to follow suit.
Sure. Let's maybe like pause on what you just mentioned and let's drill down a little bit more because I think that's very interesting for the audience. According to you, so what were the top winners and the top movers in 2025? You touched on it a bit, but can you develop that a little bit more? So what does it tell us about the market?
So the broader European indexes did very well. I mean, in fact, as we entered into 2025, Europe had its best start to a year in almost 25 years. So straight out from the traps, the index is focused on Germany. The broader European indices were doing very well, but it was amongst the sectors that a lot of performance was made. So the banks sector, for example, was up around 65 to 70%. Telcos were up around 30%. Utilities were up anywhere between 23 and 25%. And we saw record high after record high being set across the year, particularly in the second half. And that's continued into 2026 as well. We had, just before the Middle East conflict started to escalate, we had record highs set in two specific indices last week. So the attention is still there. There's particular segments on the equity side getting a lot more attention now and seeing flows migrating in that haven't been seen for years. So that whole kind of undervaluation of European stocks and their relative cheapness to the US counterparts, That's been playing out over the last, I would say 12 to 15 months. And there is still an undervaluation, not as much, but that is still getting attention. And people that were investing in some of the industrials in the US, for example, are now looking to European companies for some of that growth. So 2026, I think, will be pretty much a carbon copy of the same indices and the same sectors doing well. So the utilities, as I mentioned, the banks, barring any more contagion from the credit markets, the banks and the financial sector should do very well. Defense will continue to do well as countries like Germany spend a lot of money on infrastructure and continue their multi-year runway there around building out the industrial tech complex and infrastructure. Energy transition and utilities is another area that's looking interesting. The utilities were good in 25, but as Europe's grid investment wave continues to gain traction, and as AI and data center power demand continues to increase, you should see more spending there and therefore more investments coming into those specific segments. The other one is healthcare. So that's been a bit of a strange one. It was an underperformer last year, but there were one or two specific stocks that were doing very well, mostly around the obesity drugs that were released. So there was massive performance in one specific name. I'm not sure I can mention the name, so I won't. But in that healthcare segment in Europe, you've got a lot of work going on around obesity, diabetes, and cancer treatments. There's a lot of pipeline catalysts for the European healthcare segment. And I would imagine it won't be an industry leader next year, but it will move into neutral to slightly better performance than we saw last year, because it was a bit of a laggard. And I think there's some upside to come from that segment.
Yeah, that would be interesting to know. Sure.
If I may add to that just a second, simply because, to echo Chris's point, I've been living in Asia for 30 years. And before that, I lived in the US and all. The perception is that, Europe, you've got the EU, you need to get 27 yay votes to get anything done. And that's not going to be the kind of a team you want to have against Donald Trump, where it's a team of one vote. Right? And I think last year, Donald Trump came in with a huge win, both popular vote, college electoral vote, hugely popular swing. He started imposing tariffs and everything else. So there was a lot of apprehension about how Europe could survive this and what kind of deal could they make. And the pharmaceuticals, as Chris mentioned, underperformed a little bit because there was always that threat of sector level tariffs on our pharmaceuticals by Donald Trump. He levied it several times. So there was a little bit of a tariff risk premium added to that sector last year. I think that may go away this year. So there was always this perception that Europe would fold, and they didn't. You also have a situation in Europe politically where all of the major leaders are extremely weak in the polls, less than 40 or 30% popularity. You have a lot of elections on the agenda this year, Hungarian elections in April, if they happen, if they're not crapped. Viktor Orban has always been the nay vote in the EU. This time it seems that he might lose. He's trailing in the poll. If he does, will that turn into a yay vote after? That has implications for Ukraine, for example. You have UK local elections, which might determine the fate of whether he lasts the rest of the year as prime minister. So the UK might have its fourth or fifth prime minister in a couple of years. So, it is the perception outside that politically Europe is on the back foot and may not be able to stand up to Trump. So there was a little bit of a apprehension from going overweight Europe as much as, or at least not to go underweight US.
But I think it's been changing as well.
Last year.
There was a lot of over dominance on China, consumerism for European products. There was an over dominance on the US for defense. And if anything has changed over this last year is less of a reliance now or more of a push away from China. And also the whole Greenland situation has seen Europe. I struggle to say Europe coming together, but there's definitely more of a, let's take our defense into our own hands and not rely so much on the States for that support. So I think Europe's looking structurally a lot better than it has done in the past, and that is translating into flows and migrations of currencies and assets into European-based products. And another area, which I didn't mention, but I've noticed a lot this year, and when I last looked, it was up around 10%, is the European real estate sector. That's been one that has been largely overlooked. And now you're starting to see in the data more value potentially being had in Europe, and more of that asset allocation and reallocation of capital come into segments like that in Europe as well. So that's another sector that I think is worth looking at.
Yeah, Olivier, do you relate to that approach from a sectorial point of view in terms of trends for Europe?
Yes. So one of the things so you have to keep in mind that the European market is dominated by banks and industrial, right? To the rest of the world, not very sexy. AI is sexy, big tech is sexy, and in the US, consumer discretionary is sexy, but not in Europe. But however, this is the story in Europe. If you think about Europe coming to its own defense, that means investing in its own defense. That's all industrials. Investing in its own AI tech stack and its own AI infrastructure. That's all telecoms, and the banks are financing all of that. So these are the three biggest sectors in terms of that geopolitical mega trend of Europe taking kind of care of its own destiny, so to speak, for once. Question mark is, will those leaders still be around in a year or two, right? There's a big chance that within 2 years, Keir Starmer and Macron are out, maybe Merz also. So then what? The far right is making gains in all of these countries. There's a very real chance that at the end of 2029, the 4 biggest economies of Europe are run by far right governments. What does that mean? Right? Will they go for more alignment with Donald Trump or less?
I mean, the whole landscape remains murky, but and Olivier, you and I have had this discussion before. Politicians come and go, different, left, right, centrist, but the companies themselves are fantastic. I mean, they are the history, the quality of some of these European names. And as we often talk about the duality of these companies as well, they don't just do one thing. They're not single product manufacturers in a lot of cases. And we talk about that a lot in our conversations. These companies are doing multiple things, making, various products, and offers an immense value to investors outside of the region. And I think the key is just getting that message out there, and for people to understand what goes on in Europe and how it's, how the companies are built and what exactly it is they do. And I think the value gets unlocked regardless of whoever's in power on any given year.
Yeah, maybe we can wrap this up with a question for both of you, actually. Maybe bad cop, good cop question. Good cop question for you, Chris. So what do you see as like an interesting opportunities in 2026 for European markets? And maybe after, Olivier, if you can tell us, like, what do you think we should be cautious about for the European market? Maybe we start with you, Chris.
Depends how long this nonsense goes on for. I mean, one thing that we've all seen over the last 10 years is that the markets tend to react less and less to massive events. Will what's going on be a blip? Will markets rebound and start to print all-time highs again in equities, next week or the week after? We just don't know. But I think with the lens of time, I still think that Europe and passively investing into Europe and dollar cost averaging into some of the products that we have in Europe is still a very good way to go. And I still think there's a lot of value for European markets over US. I think the asset reallocation will continue, and in fact will probably only get stronger as we, move through the last few years of the Trump presidency. And then who knows what happens when his term finishes. Maybe he gets another term. We just don't know. I mean, it's unlikely, but you never know. And I think we benefit in European markets from this global uncertainty. And I think it still comes down to value and the quality of the European names that we trade and we hold in our indices.
Understood. Yeah, you mentioned about the health sector and the real estate. That might be 2 sectors interesting for Europe, maybe. Okay, and Olivier, so on the other side, just what are things that should be mindful in the European market, or what are the signs or the inputs that we should be concerned or have in mind in our portfolio for Europe?
Sure. So, I mean, to be clear, I liked Europe since last year, and I think Europe is going to outperform the US for 5 years. That's what I said back in January last year. I still believe that's the case. So, if we look at some of the things that might trip that, one of them is obviously the US-China relationship, right? It's very bad right now, and Europe benefits from that. But there are two meetings on the books between Trump and Xi this year, one at the end of this month and another one in November. You know, if they were to reach, one of those big global beautiful deals that cuts out Europe, that's a risk that people need to think about. The other one is obviously the USMCA renewal in July. So if right now Europe benefits from the fact that the US and Canada are no longer friends, and Canada is now cozying up to Europe and cozying up to Australia and other things like that. But if the renewal of this trade deal is vital for Canada and Mexico and the US. So if as a result of these negotiations, a big, beautiful renewal deal comes up and they are back to being friends again. And one of the conditions Trump will ask is that you cut off Europe for sure. So these are the two things I would at least watch on the calendar. Those are two things that could potentially trip investors' love of Europe, recent love of Europe.
Excellent. Well, thank you very much, both of you. Your insights are really educative and informative. That's very important for the audience. I hope we'll have the opportunity to have other podcasts together to talk about Europe or global macro in that perspective. Thanks, Chris. Thanks, Olivier.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com.